So if we move on to purchase orders, when you raise a purchase order in VCO, again, we will sync this through to Xero. And if I jump into Xero and click on accounts and click purchases, so here it will show you, they will always go into awaiting payment. So if I click into awaiting payment, I can see that I have a purchase order here raised on the 14th of July. The due date is set as the 14th of July, but for a supplier, you can actually, if you head to contacts and click suppliers, so there's my default supplier, and click edit. So what you can do is set a bill due date and an invoice due date. So if you set this, it means that this will reflect when we send a sales invoice through to, a purchase order through to Xero, and the client clicks on it. Instead of being due immediately, it will show the true due date. So this is showing 3 purchase orders where a supplier bill or supplier invoice has been raised. I haven't paid anything yet. This is what is due. So if I click on this purchase order and click batch payment and click OK. So I will give a payment date of today. It's coming out of this bank account. So again, the money I've got in the account will be reduced here because I just paid a bill. And if I click make payments, when I head back now to my purchase orders, there should only be 2 left in awaiting for payment. Yep, there we are. If I click on paid, I can see all the purchase orders that I've actually paid. And again, with purchase orders, we don't send anything through the line items or send any inventory through. It's purely, this is how much we've paid. So in turn, on this invoice, £10,000 has been added to my stock on hand because I've bought this much in, and so on with every single purchase order you raise. It will constantly recalculate the figures on the profit and loss in the balance sheet to show how much stock you're still holding. And again, as we said, anything that you get in has cost you something to take out. So what does happen though is, we mentioned in the cost of goods earlier, so we set for the Magic Mouse £10. However, every time you raise a purchase order, it may be that you pay different amounts each time you order something. So VCO will constantly recalculate based on the purchase orders the average cost of goods sold. So if you, for example, you've bought purchase order 1, you buy 10 times product at £10 per item, then you raise another purchase order for 5 of product at £8 per item. The average cost of goods now for product A will be £9.33. So next time you get a sale and we create the sales invoice and we also create that manual journal for the cost of goods sold, rather than send to that static £10 figure, because that is no longer true because you bought some cheaper, we will send through in the cost of goods sold as £9.33, which will give a much more accurate profit and loss statement. So you'll see exactly how much it has cost you for each sale based on the history of the purchase orders. So the more purchase orders that are raised in VCO, the longer somebody's with VCO and they're sending purchase orders through with varying prices, it will really give them a true figure of the overall profit and loss at the end of the year. So if I just show you keep mentioning this balance sheet and the profit and loss, if I just give you a quick overview of that now, you'll see what all of that was relating to. So on reports, again, a lot of reports, but the ones I'll show you are the balance sheet. So the balance sheet So that is going to be made up there. So this will give you your total assets, essentially made up of the money in the bank, current stock on hand figure, so this figure here, minus any cost of goods sold. So that's your assets, total assets, money in the bank, inventory you've got to sell, minus the cost of goods sold. Then you have your liabilities. So this is purchase orders already paid, VAT paid, minus any opening balance and any purchase orders you haven't paid yet. The net assets will then be calculated, obviously taking away your total liabilities from your total assets. So this is everything you have. This is everything you essentially don't have or are liable to pay out. And at the bottom then, it's going to give you your equity. So current year earnings, which is your gross sales, which includes the sales and shipping fees, minus your cost of goods, should give them the total equity for the year. So the balance sheet is always changing. So as we said, you get money in, that's fine and well. You get £100 in. But to get the £100 in, you're losing from your stock on hand. So that's being deducted because you're sending a certain valuation amount of stock out. It cost you money to buy the item in the first place. So the cost of goods sold, VAT and so on. So this all should balance out. Everything in accounts needs to balance out and be accounted for. Anything you spend, anything you get in, and that should give the true overview of how good the business is doing. If we head to the profit and loss, so again, a little bit less in depth, the profit and loss. So this is total income. So how much money have you had in? How much money has gone out? Giving you your gross profit. So I've received £904.65 in sales and other revenue. So sales being my overall sales values, other revenue in my example is the money I've received in for shipping. And then obviously the cost of goods sold. So for all I've received in £904.65, that's obviously not all profit because it cost me £643.06 to buy the items in to be able to sell. But that gives me a gross profit, net profit of £261.59. So this is where you can really see, is a business making money or not?